Welcome to the webinar for fourth quarter economic outlook for US. I'm Zhen Hui, investment analyst with Phillip Futures. Disclaimer: this presentation is solely for educational purposes. Do not treat it as investment advice. In the next 20 minutes or so, I will bring you all through a review of the third quarter GDP, economic backdrop of US, and the outlook for the fourth quarter GDP. US economic growth picked up in the third quarter, bolstered by robust consumer spending, an ameliorating housing sector, and higher defense spending. With fiscal cliff looming, what could be the possible trajectory of the US economy going forward? Let's analyze the underlying growth drivers in the third quarter to see if they are sustainable. This chart shows the annualized GDP growth of US over the past 2 years. The orange bar on the far right shows the market expectation of the GDP growth in the third quarter. The actual data came in slightly above market expectation. In fact, the growth rate has increased compared to the second quarter. In the next few slides, we will look at the supportive drivers of GDP growth in the third quarter. The individual line that will be superimposed on the bar chart shows the contribution of each drivers to the GDP growth. After subprime crisis, residential housing has shrunk, and this has weighed on the GDP growth. Notably, in September 2010, when residential sector shaved off more than 0.5% from GDP growth for that quarter. However, we are seeing signs of gradual recovery in this sector. The extremely loose monetary policy by US Federal Reserve is likely to be supportive of residential housing in the next few quarters. The latest round of quantitative easing, QE3, targets the purchase of mortgage-backed securities and is likely to keep mortgage borrowing costs low. This would in turn increase the demand for residential housing, resulting in acceleration in housing price appreciation and construction activity. Although residential sector does not make up a large percentage of the overall GDP, a more robust residential housing does have an indirect impact on the GDP growth. An increase in residential housing sector would have a positive knock-on impact in the other segment of the economy, such as consumer spending. This is because it would boost consumer spending complementary to housing activity, such as expenditures on home furnishings and major appliances. This leads me to the next supportive driver of the GDP growth. Personal consumption expenditure is a component of GDP that measures the goods and services consumed by individuals. This sector makes up more than 2/3 of the GDP of US. Hence, the willingness of consumers to spend could dictate the direction of the GDP growth. Economic data up to early November suggests improvement in this segment of the economy. Steady increase in housing prices and stock prices make the US consumers feel wealthier. We also witness improvement in consumer confidence and job situation in US. All these would increase the propensity of consumers to spend, therefore boosting the GDP growth. On the defense sector, we suspect that the spike to above 0.5% in the last quarter could prove to be short-lived. With the upcoming fiscal cliff, we do not foresee further increase in the government spending in the defense. This supportive factor could become a drag on the GDP growth in the next quarter. From supportive drivers, now let's move on to the factors that has negative contribution to the GDP growth. For the past few years, business investment has been a consistent supportive driver for GDP growth. However, business investment has been trending downwards over the past few quarters due to the looming fiscal cliff as business put off investment in capital goods and hiring decisions. We also noted that net export contribution to GDP has dipped below zero again due to sluggish global growth, especially in Europe and US. Slower global growth is likely to result in slowdown in growth contributions from exports. Finally, we have farm inventory, which constitutes the largest negative contribution to GDP growth in the third quarter out of these three factors. Although farm output only makes up a tiny portion of overall GDP, the impact of the Midwest drought on the third quarter growth was so severe that it reduced 0.4% of the GDP growth. The GDP growth contributions reflect divergent paths taken by household sector and business sector, as households appear to have a more optimistic outlook, while businesses appear to be cautious over slowing earnings. This divergence takes place on the back of the US economic backdrop characterized by extremely loose monetary policy, global slowdown, and fiscal cliff. In September Federal Open Market Committee meeting, Federal Reserve out-eased other central banks by rolling out QE3, an open-ended purchase of mortgage-backed securities at the rate of $40 billion per month. Unlike previous quantitative easing, there is no stipulated limit to QE3 in terms of quantum and duration, and it will continue until Federal Reserve deems that the outlook of labor market has improved substantially. Furthermore, FOMC extended the forward guidance on federal funds rate target to remain near zero until at least mid-2015. Extremely loose monetary policy appears to have gained the most traction in household sector, as evidenced by the increase in GDP growth contribution by personal consumption expenditure and residential housing. One of the barometers to confirm the optimistic outlook of household sectors is the Consumer Confidence Gauge. The blue line shows the Consumer Sentiment Index compiled by University of Michigan. Consumer sentiment rose to 82.6 in October, a 5-year high. Preliminary Consumer Sentiment Index in November rose to 84.9, the fourth straight increase, beating the median estimate of 82.9 for November. The red line shows the Consumer Confidence Index compiled by Conference Board. The index has hit the highest level of the year, with improvements in the job market as the major driver. Consumers are more optimistic about their financial situation and the short-term economic outlook. Record low interest rates are providing homeowners with an opportunity to reduce their monthly mortgage payments through refinancing at lower rate. By reducing the monthly mortgage payments, consumers have a higher discretionary income for spending. Job growth has been sluggish but fairly steady over the past 2 years, and incomes are rising again as households work their way out of debt. The stock market has been strong, particularly in the third quarter, and the housing market is finally beginning to improve. The increase in household wealth from real estate and stock market encouraged more households to spend. These factors could translate into a sustained improvement in car sales and other durable consumer goods spending in the coming months. Slower global growth, particularly in Europe and Asia, is likely to impact US corporates through two channels. Firstly, it's likely to dampen earnings growth of major American multinational corporations with significant presence overseas. Secondly, it is also likely to result in lackluster export growth. Although aggressive policy actions from major central banks in the world have reduced the tail risk, particularly the ones associated to Eurozone, the timing of global growth picking up again remains uncertain. Eurozone appears particularly weak. Manufacturing continues to be in contraction mode, with job losses recorded in almost all nations. Although recent data from China points towards stabilization of economic growth, we are not so optimistic of the pace of the recovery and expect the structural growth momentum to be lethargic. In the latest projection by IMF, we see an across-the-board downgrade in the economic growth this year, except US. This substantiates the story of global growth slowdown. There are two key assumptions made by IMF in coming up with these estimates. The first assumption is that European policymakers keep the euro area debt crisis under control. The second assumption is that policymakers in the United States take the necessary measures to avoid the fiscal cliff. Failure to address either issues could make the growth prospects far worse than these projected figures. According to IMF, most periphery economies within Eurozone are likely to undergo a steep contraction in 2012, constrained by tight fiscal policies and financial conditions. They are projected to recover only in 2013. Although growth in China is downgraded by IMF from 8% to 7.8%, accelerated approval of public infrastructure projects is likely to boost the economic activity, offsetting the bleak external conditions. as the post-earthquake reconstruction winds down in Japan, the pace of growth is forecast to stagnate in the second half of 2012. Without a particularly robust growth engine within the major economies, export in US is likely going to take a hit in the final quarter of 2012. Fiscal cliff refers to the simultaneous tax hike and spending cut in 2013 which could tip the US economy back into recession. The effects of fiscal cliff is likely to permeate into the broader economy via two fronts, namely consumer spending and business investment. On consumer front, the tax hikes would cut down on disposable personal income, which in turn would lead to lower consumer spending. Potential slowdown in both government spending and consumer spending would cause businesses to be less optimistic and reduce investments prior to the effective date of fiscal cliff. This could lead to job losses. In essence, fiscal cliff does not bode well for the economy and could roil the market sentiment. Recent economic data suggests a divergence between consumer and business. Consumers appear to be unaffected by fiscal cliff for the time being, while businesses appear to have scaled down their investments. This is evident from the core capital goods orders, which slumped by 23.5% in Q3. One possible explanation why businesses are more cautious compared to consumers is because consumers are more nimble and are able to adjust to spending compared to businesses better. Being more sensitive to fiscal cliff, businesses are waiting, letting cash pile up on the sidelines and curtailing new business commitments until policymakers strike a deal. This poses the risk of self-induced recession and could have a negative feedback to consumer spending as delayed hiring decisions by businesses affect job creation. To sum up, the US economic backdrop, we see weaker exports and a decline in business investment as a reflection of the global slowdown and uncertainty over US fiscal policy. While extremely loose monetary policy could continue to provide support to the economy, the external headwinds coming from global slowdown and internal headwinds coming from fiscal cliff could prove to be too strong for monetary policy to overcome. In assessing the outlook for the fourth quarter, apart from the current economic backdrop, we will be looking at the impact of US elections, Hurricane Sandy, and expectation of further monetary accommodation by US Federal Reserve on the economic activity. US election results did not present Obama with full control of the Congress, as Republican maintains the majority of the House of Representatives. This increases the likelihood of political gridlock as Obama endeavors to strike a deal between Democrats and Republicans. Depending on how the fiscal cliff pans out, there could be a huge risk-off scenario towards the end of the year, which could see US dollar strengthening as investors flock to safe haven currencies. This may take a huge toll on the economy as consumer spending slows down in tandem with a weaker business investment. Due to the immense potential impact, we expect House of Representatives, Senate, and White House to work together to avert the effects of growth-inhibiting fiscal tightening scheduled to commence in 2013. The sooner a compromise is achieved, the better it is for the economy. Hurricane Sandy has wreaked havoc on the transportation system and cut the power supply of the major cities in the US. Business activity has been halted and it will take several weeks for everything to resume to normality. This reduces the productive capacity of the economy. Hence, from a supply side perspective, this disaster is likely to weigh on the economy in the short run. The recent blip in October retail sales is the reflection of the negative impact of the hurricane on the various supply channels. Due to the temporary closures of stores in the Northeast, traditional brick and mortar retail sales were dampened. Shortage of electricity adversely affected online shopping. While disasters usually destroy wealth, it is actually possible for it to boost GDP in the longer run because GDP is a measure of economic activity and not the total wealth of the economy. Hence, from the demand side of the economy, the disaster can be positive to GDP as it would result in increases in private and public investment as well as government expenditure as reconstruction work adds jobs. This boost in demand operates on a slightly longer time frame. When you consider the supply and demand side in totality, the likely impact of this disaster is that it would weigh on the economy in the short run and adds to the GDP growth in the subsequent quarters. In the Currencies Market Outlook published in October, we have expressed our view that the Federal Reserve could expand the quantitative easing tree to include US Treasuries after Operation Twist expires. Expectation of further monetary accommodation from US Federal Reserve has heightened after the release of the most recent Federal Open Market Committee minutes. According to the minutes of the meeting, a number of participants indicated that additional asset purchases would likely to be appropriate next year after the conclusion of the maturity extension program to achieve a substantial improvement in the labor market. Our base case scenario for the size of increase is 45 billion US dollars, which replaces the amount of US Treasury purchase involved in Operation Twist. This is unlikely to have much incremental impact on the GDP growth. Even if US Federal Reserve decides to ramp up QE3 by more than 45 billion US dollar, extremely loose monetary policy is unlikely to offset the negative impact of Hurricane Sandy and fiscal cliff. To sum up, we tend to be pessimistic on the US GDP growth for the fourth quarter, given the fact that the US election resulted in a split Congress. This would cause consumer and business to curb spending and investment due to fiscal cliff uncertainty. Hurricane Sandy would weigh on the GDP growth for the fourth quarter as it reduces the productive capacity of the economy. The extent of the negative impact of the disaster on GDP growth would depend on how fast the reconstruction work takes place. Even if the US Federal Reserve were to expand quantitative easing tree, it is unlikely to overcome the internal headwinds and external headwinds such as global slowdown in the fourth quarter. For more information on the trading strategies appropriate for this kind of market environment, feel free to approach any representatives from Phil Futures for a further discussion.